Imagine reading a press release where a struggling company that sells minimalist wool shoes announces it is suddenly, as of today, an AI cloud services firm. A decade ago, Allbirds was the unofficial uniform for Silicon Valley tech workers. If you were pitching an app or writing code, you probably had a pair of these on your feet. That popularity peaked in November 2021 with a blockbuster initial public offering. The shoemaker raised over $300 million right out of the gate. This chart tracks the company's valuation timeline, showing exactly how high that IPO pushed them. At their peak, investors valued Allbirds at more than $4 billion. But consumer trends move fast. In the months that followed, demand for the shoes dried up, and the company's financials rapidly deteriorated. Following that same valuation trendline, we see how far the stock plummeted. Right before they announced their sudden pivot, the company was trading at just $2.49 a share. They needed capital to survive. But instead of designing a new sneaker or cutting costs, executives looked for a lifeline in the most lucrative tech trend of the decade. When a physical product fails, slapping a trending tech buzzword onto the corporate letterhead provides a fast, artificial way to attract investors who are hungry for the next big thing. To pull off a corporate pivot of this magnitude, the company first had to entirely sever ties with its physical past. In March, they struck a $39 million deal to sell off the entire footwear business. When the deal closes in the second quarter of 2026, the shoes, the designs, and the legacy will belong to the American Exchange Group. The American Exchange Group is a brand manager whose portfolio largely consists of other fashion labels, like Aerosols and Ed Hardy. Liquidating the physical supply chain and inventory serves a very specific purpose. It strips the company down to an empty corporate shell, ready to be filled with whatever narrative the market is currently buying. With the shoes gone, the company rechristened itself Newbird AI. To legitimize the new name, they announced a $50 million capital injection from an unnamed institutional investor, specifically earmarked to build AI compute infrastructure. The press release hit the wires on a Wednesday morning. The reaction from Wall Street was immediate. This stock line chart shows the exact moment the market opened that morning. The price surged over 800% in a near vertical climb. Following the line further into the morning, the extreme volatility cools off, stabilizing around $20 per share by 11:45 a.m. The math here is instructive. Wall Street enthusiastically rewarded a failing shoemaker strictly because it promised to enter a trending tech sector. We know this dynamic exists because we have seen companies run this exact playbook before. In 2017, the Long Island iced tea company found itself in a similar position. Their core beverage business was struggling to stay afloat. They executed an identical maneuver, abruptly pivoting to the hottest tech trend of 2017 by announcing they would primarily become a blockchain company. This graph plots the two events side by side. On the left is the 2017 iced tea stock spike. On the right is the 2024 Allbirds spike. The visual pattern is virtually identical. Investors in both eras bid up the stock based entirely on the inclusion of a popular word in a press release, rather than any proof of operational readiness. Which leaves us with the practical question: what actually happens to these companies once the initial stock surge fades? For the Long Island iced tea company, the pivot ended in failure. In 2021, they were officially delisted from the stock market. The Securities and Exchange Commission issued an order explaining exactly why, stating flatly that the company's new, quote, blockchain business never became operational. The fate of that 2017 pivot sets a clear expectation for Newbird AI. The company has $50 million, but they still have to prove they can actually build working AI infrastructure from scratch. When a company completely abandons its core product to chase a trending technology, it rarely signals actual innovation. It is usually a recognizable red flag, masking a desperate maneuver to stay alive.